This Ticker podcast is coming to you from the Citadel Securities Trading Post on the floor of the New York Stock Exchange.
Hi, everybody. In the time before the virus, one otherwise obscure asset class with a ambivalent history was making a spectacular comeback. SPACs, special purpose acquisition companies. Last year, a record 59 SPAC IPOs raised together almost $14 billion. That's almost a quarter of the entire U.S. IPO market. Now, who knows where the SPAC goes going forward, but I think they'll continue to thrive. One reason? They've got this unique structure that, in theory, insulates them from changing market environments. So, quick refresher, SPACs fall into the alternate IPO category. SPACs have two parts. In part one, a SPAC forms when investors give what is basically blank check money to a convincing management team. Those people, the sponsors, then have 2 years, usually, to buy an operating business. Pretty well, any operating business. So then comes part two, the de-Spac part. The operating business and SPAC combine through a reverse merger. ARBs move out, a whole new gang of fundamental holders eagerly move in, and boom, the private company is now a public one. Quick, smooth, easy peasy. Unless it isn't. My guest on this Ticker podcast says the de-Spac is the hardest part, and the part some sponsors regret skimping on. And he says, de-Spac IR isn't your regular sort of IR.
This is kind of investor relations on some sort of stimulant.
Phil Denning is a partner at ICR. ICR is the biggest communications player in the SPAC space. Phil has this wonderful biographical anecdote that I think may reveal a lot about Phil, his life philosophy, and ICR's proactive and successful approach to SPAC communication.
When I was a kid and wanted to make money, myself and my brother, we wanted to have a landscape business. We wanted to mow lawns. And so we go out and we were like, okay, what are we going to do to get clients? My mother said, you go out and you maintain our yard better than anybody else in the neighborhood. And anybody that asks, I'll tell them my boys did that and they're available for hire. It's like, okay, that seems like a long sales process. I would rather go out and start to try to generate some awareness and some visibility that we're here, we want to work hard. Right. So I think that's what it really comes down to, is saying, hey, look, we want to get out there and tell our story, and you have to be aggressive in going out and articulating it, not sitting back. So I think maybe some people feel like, hey, I've been a very successful executive, or I've got great advisors from a banking perspective, and that should be enough. And if I find a good transaction at a good valuation, shareholders will come and find us. Unfortunately, I think that's proven wrong by the research, which is if you engage an advisor and you get out there from an investor relations perspective, putting all that infrastructure in place, preparing to be a good public company, as well as getting out and telling that story rather than waiting for them to come find you.
Phil Denning stopped by the Citadel Securities Post just at the very cusp of the coronavirus arrival. On this Ticker podcast, SPACs, where they come from, why companies and investors like them, and what makes SPAC IR special.
First of all, SPACs are much more popular than I thought.
Yes.
Can we sort of talk about the evolution of the SPAC market and why it's having a resurgence now?
Yeah, it's interesting. It used to be, the perception was that it was a listing option of the last resort. Now, I think that there's been a few things that have changed that have driven the overall growth of the SPAC market and where we are today, where I think 2019 was a record year. There's about $24 billion in capital out there looking for transactions that are in SPACs. So I think there's a couple of things that happened. The main thing was that late 2011, early 2012, there were some changes from a regulatory standpoint and kind of the structure of the SPACs, as well as in listing standards. So there was the ability to list on the exchanges. So the big changes were that there a change in the vote structure. It used to be that you required a supermajority vote to approve a transaction. Now it's majority. There's a change in the redemption threshold, so the shareholders of the SPAC IPO have the ability to redeem for the cash. It used to be a very high threshold that you had to meet. Now they've lowered that threshold so that the transactions can go forward. So they've reduced the hurdle to getting a transaction done.
The exchanges?
The exchanges and the SEC.
Okay.
So that's made it more easier to get a transaction done, lower the thresholds, if you will, or the hurdles. The other thing that's then happened is you've seen the quality improve. So as a result of those changes, you see bigger banks underwriting the deals. You see the exchanges that are listing the IPOs, and they're competing for that business, the IPO business, because they know they'll get the ongoing listing if there's a successful transaction. And then you've seen the institutional investor market, the private markets, private equity firms, as well as the institutional investors seeing the value in the IPO. They kind of going public through a SPAC transaction. And then you've seen the quality of the sponsors, the repeat SPAC issuers. They are very experienced management teams, because a seller needs to know, yes, they're going to get capital as part of the transaction, but ideally the sponsor is going to provide them with some experience and expertise in driving their business forward. So I think the combination of all of those things has led to this significant increase in SPAC activity.
What makes a SPAC different from a direct listing or an IPO? And along those lines, and pardon my ignorance, just kind of an eddy segue here, why wouldn't that private company just do an IPO itself? Why would it wait for a SPAC?
There are a lot of differences in kind of why you do it. Okay, so I think one that's is time and certainty. Those are two things: time and certainty. So and I'll talk about it from the company side, but also from the investor side, the advantages to it. So as a company, when you enter into the SPAC transaction, you have the SPAC is a traditional IPO. They raise a pool of capital that 90% of the funds are put in a trust account, and then they go look for a transaction. So there is the IPO element of it, but now they go and look and say, okay, now that private company, you're going to go public through a SPAC merger. And so the certainty of the timing and also the valuation. So the transaction valuation is agreed upon as part of that merger agreement. Whereas an IPO, you go out on the road and you say, okay, we're going to list between $12 and $14 a share. You go out, you do all the meetings, and then all of a sudden you get to the pricing meeting and say, okay, well, actually we're going to issue fewer shares at a lower price, or we're going to be above the range. So you don't know where the valuation is going to be, but there's valuation certainty. So as a seller, you know that, and then you have to go out and market the transaction. So that's the benefit from a seller perspective. Now, each SPAC is different. So let's say that it's a private equity-backed company. The sponsor has, sometimes they're looking to pull out cash, and other times they don't need to pull out cash and they want to roll their equity into it. So they have the option in both ways. So versus an IPO, they're going to be giving up some of their equity, taking it public, and then looking for opportunities down the road to exit their position through secondaries or other transactions. Right, so this kind of gives an interesting opportunity here where they can decide, if it's something where they want to take the cash off the table, or if they want to roll their equity and continue to participate in the upside for the company. And then if I can then talk maybe for a minute about like the difference of from the investor side. So a big thing is it's been about the IPO Roadshow. The difference is in an IPO, you're on the road for 2 or 3 weeks out there selling it, and as an investor, you're limited from the company side as to how much information you can put in the marketplace. It all has to be through the SEC filings, and there's the IPO quiet period and all that goes there. So now the investors get one meeting, or maybe they're in a group lunch and they have to decide what they're, if they're going to participate in the IPO. Then they got to figure out what their allocation is going to be in that IPO. Versus a SPAC, there's a couple of months window between the time that they actually announce a merger, a business combination, and then the transaction closing. So they've got a lot more opportunity to engage with the management team. They have the ability to share forecasts versus what you're not be able to do through a traditional IPO.
Right.
You have the ability to meet multiple times if you want, and then you have the ability then to get more comfortable with the valuation and understand it, and it gives the company the ability to leverage the media to get out there to tell their story, talk about it. You have to have an attractive valuation in order to keep the investors engaged and want to say, okay, I want to stay in this stock. But you also need to articulate a growth strategy, and how are they going to see shareholder maximization? How are they going to see value enhancement? So that's part of it. There is getting out and telling that story, and you have, versus a traditional IPO, you could be out there engaging with those shareholders, telling that story, leveraging the media, and also making sure that your employees, you're engaging with them and telling them the story as well, and getting them excited because they're going to be a public company. They're going to hopefully participate in the equity as well through incentive compensation, et cetera.
There are two different phases to a SPAC. There's a SPAC and there's this other de-SPAC process.
Yes.
A word I really like. The investors in the SPAC, you expect them, they're just there for the transition. You expect them to move out, right?
There's
de-SPAC time.
There's a certain amount of turnover, yes. So there's I would say that there's probably 4 phases of a SPAC.
Okay.
You got the actual IPO, going and raising the capital. Then they identify a target. They announce that transaction. Then you go through the de-SPAC process, right? So then you're a publicly traded company once you have the successful de-SPAC process.
When do you ring the bell? Is it at the SPAC, or is that when the merger company is announced?
You could probably do both, right? So the exchanges are obviously wanting to get the listings. They want the issuers that are going to come to the exchange. So that's a big moment for someone who's a SPAC sponsor experienced, and they want to be able to celebrate that because it is a great moment, and it's at a step in the process and raise the awareness and say, hey, we've raised this pool of capital, we're looking for a target within this space. So they want to be able to leverage that as the sponsor, so that you want to ring the bell and you want to do some awareness campaign and get out there and let people know that you're looking for a deal.
And that's a good way to do it. In fact, I'm just thinking, in an IPO, you can't necessarily do that because you don't really know when your IPO is.
Correct.
Right.
Correct. Okay. And then you have now you've identified a transaction. Once the transaction is closed, hopefully you're able to, now you become typically the name of the company is going to change, the ticker may change, so you'd want to be able to do a bell ringing at that point as well to come down to the exchange and celebrate that milestone in that the evolution of that company now becoming a publicly traded entity. Okay. And it's a great way to celebrate with the deal team as well as the employees.
Do you have a preference for where a SPAC should be listed?
I don't. So we've worked with SPACs that have been trading New York Stock Exchange, NASDAQ equally. I think that they're equal.
Would it be a question of size or industry? I mean,
I think
two different market models too, right?
Yeah, well, I think that the market structures are converging. I think so. Is technology playing a bigger role in the transparency, pricing transparency, pricing discovery? So I think that I think the markets, there's certain things that each one brings different, and I think that historically NASDAQ was maybe thought more of like the younger technology companies, and now you have major technology companies that are listed here in the New York Stock Exchange. So I think that's become less of it. I think that some people like what New York Stock Exchange offers from a brand reputation and cachet. So both of them bring a lot of great things to the table. So from our side, from the investor relations perspective, the listing where you choose to list is less of a concern, less of a differentiation, and more about that's going to be the life as a public company. And I think both exchanges do a great job of supporting their issuers.
Okay, fair enough. So let's begin with the life cycle then.
Yep.
You get the call. It's Thursday morning.
Right.
The management team calls you up.
Right.
We have some thoughts on who we'd like to buy,
Right.
but we don't really know yet.
Yeah.
Take
Go
it from
for it.
there.
Yeah. Okay. So in that scenario, now we'll assume that they have already. I don't know, I assume that they've already listed, so they've raised the SPAC, and then they call us and say, okay, we've raised the money, now we want to get out there and find a target, and we want to get our name out there. So I'll use that as the scenario. So the SPAC issuers come to us and say, hey, we've identified the particular industry that we want to do a transaction in based on our legacy, experience, and expertise and knowledge. So what we work with them at that point is really awareness, getting out there, and so because they want deal flow coming to them. So that's going and say, okay, what industry conferences should you be at? Going out there, seeing companies, private companies, getting to know what the market is and who the players are, raising the awareness, letting people know that you're in the market looking for a transaction, getting out there and talking about, as I said earlier, one of the things that a seller is going to be looking for, not only capital, but that expertise and experience that a sponsor is going to bring with them. So we want to be able to make sure that some people have already established great media profiles through their history in prior companies, and others have been very experienced operators, but maybe not have had that public markets awareness. So we want to get out there and raise their visibility as well within the target industry media, and say, hey, look, these are experienced executives, raise that profile, and then help them as part of the process of identifying targets. Now we get.
I want to just circle back to that, but
Yep.
I'm a little confused. So, in the SPAC, you're not involved with the original SPAC listing.
Typically, we can be, but most of the time that it's. I personally haven't worked on a SPAC prior to them doing the IPO.
Why not?
Get
Because
brought
they
in.
they know the people to contact. And...
I guess it's mainly been more the bankers that they work with. They have a certain sense as to the ability to get a transaction done.
All right.
And the typical buyer of a SPAC is a little bit different investor. They're very experienced in the SPAC structure, so it's a little more limited audience.
But this
that
used
they're
to be
going
retail investors who are into SPACs.
Right, but now it has transformed, because as I said, some of those structural changes have made it more attractive for institutional traditionally hedge fund investors. Some will call them like more cash arbs. They had the ability to park some cash with very little risk, and then they have the option, if they like the transaction, they have the ability to continue to enroll their equity, or they have the option to say, I would rather take my cash back, or if it's a successful transaction and the stock trades up, they have the liquidity then to make a decision. So I think that it's become more attractive as a result of some of those changes that have happened through the last 8+ years that have made it more attractive to institutional investors. And then you see we actually just did at ICR, we just published a kind of a year in review 2019 SPAC primer, and so available on our website, icrinc.com. You can check it out, and you'll see who are the biggest institutional buyers at the IPO, and then who are the bigger buyers in the de-SPAC process. So you're getting more into the fundamental shareholders, the Fidelities, the Wellingtons, the Vanguards of the world, because they then now coming in and saying, okay, because they're buying the management team and the company that's going to be continuing to list.
So that's the transition where they would come to you, because there's a relatively limited number of SPAC specialists, institutions.
I think it's growing. I think that there's a growing understanding of the optionality that they have, the certainty from a cash perspective, and then the ability to bet on a management team and get a sense as to get a comfort of particularly when you have experienced issuers, people that have done 2, 3, 4 SPACs. Those shareholders have a better sense as to their ability to identify a deal, close a transaction, and have it trade successfully.
So then they'll bring you in.
Correct. So now we're involved.
They've been trading for a while.
Right.
Hopefully.
Yeah.
I mean, trading.
Yep.
Doing okay, and then they have picked a target, and they come to you and they say, we need to expand our investor base and convince them that this is the target and show them how great their operation is.
Right. So yes. So now at that point, so they after they list, they have, and that was another change that actually happened as well, going back to the 2011-2012 period, was they expanded the window of time they had to complete a transaction, to identify a transaction and announce it. So now I think you have up until 36 months. Most of them are going to be in a 24-month period to identify a transaction or a target, a business combination. So in that period, we can help the SPAC sponsor raise their profile, help drive deal flow. They've now identified a target, a business combination. So we then work with the management team of the target. Is now they are historically been operating as a private company. They need to be battle tested and ready to get out and meet with investors, institutional investors. So we work with them at that point then is saying, okay, we're going to help you with all the merger announcement around that transaction. So there's going to be, again, we want to get the media attention. So we want to make sure that we've got a media strategy around the business combination
you
transaction.
You work with both groups.
Correct. They do this, yes, exactly. So we're working with both groups, because now you are into the merger process. So you have to live within the restrictions of a publicly traded vehicle, that is the SPAC. But also then you have the ability, a little more flexibility versus a traditional IPO about getting out and telling the story. So you announce the transaction. You want to have a strategy around that from a media perspective, but also you want to make sure you have their messaging right, and they have the management team has been trained, so that we're going to help them with all the communications internally and externally. Make sure you're getting your employees excited, but also helping them understand, hey, look, we're going to now have to operate within the confines of being a publicly traded company. So if the media calls, you can't start talking to them. You got to make sure that they understand. You can't start tweeting about how the business is doing or anything along those lines. So you help them through all that process and prepare for then going out on the road. And now we get into the process of raising the awareness, and that's we always say there's a ground game and an air game. The air game is that media. Media is a very blunt instrument, kind of getting the message out there. But then the ground game is the hand-to-hand combat with the shareholders, getting out there and getting them excited about the transaction. So talking about that valuation, that has to be attractive. Then you have to be able to just tell a story about, okay, yes, we know it's a good transaction, but then what's the opportunity long-term from a growth perspective? So how do we help them articulate that growth story and package that story and get it out to the shareholders? And as I said, versus a traditional IPO, you're going to have, multiple opportunities to engage with institutional investors during this process. So there will be, a lot of times in a SPAC transaction, there'll also be a PIPE, which is a private investment in a public equity. So it's another vehicle of raising additional capital around the transaction. So during this process, it's called wall crossing process, which is bringing in institutional investors, spending more time with them, and they are going to be making an additional investment into the transaction. If it's successful and the shareholders vote to approve it, then they raise additional capital. So if it's something where they've identified a target where they need to raise more than what's in the trust, they need to go out and raise additional capital.
Is that a risky thing? Are there occasions when the shareholders don't vote for that?
There are occasions where the shareholders don't approve the transaction, but I think that most of the time you have a pretty good sense, because I think particularly the experienced issuers have recognized, hey, look, that we need to make sure that it's a compelling transaction, and it has to be something that's attractive to the shareholders to vote in favor of the transaction. So interestingly, an organization called SPAC Research just did an analysis of SPAC IPOs since 2015. They went back and looked and said, okay, which companies used an IR firm and which ones didn't, and looked and tracked to see, okay, how do they perform? And not surprisingly, about half, a little over half, used an outside agency, and those that did outperformed. And because I think whether it was a choice from a cost perspective, or if it was something where the inexperienced issuers said feeling that they could handle it on their own, not appreciating all the things that need to go into that de-SPAC process. Right. So we say that this is kind of investor relations on some sort of stimulant. Like, you really need to get out there and aggressively engage with the shareholders. It's not, the difference is that, during a traditional IPO, you have the book building process, right? So those people are buying, they know what they're investing in, versus now you're coming in as the company that's going to be merging with this publicly traded vehicle, and those shareholders, you're inheriting a shareholder base. So you know that there's going to be, some of them are going to continue to be shareholders in the new company, the newly formed public company, and some are going to choose to sell, or they're going to take their cash back. But you need to now build a shareholder base that the more traditional fundamental investors that understand your industry, that understand your business, and are buying into that.
And you have to do that quickly. You have to line them up fast because there's going to be this leakage,
Correct.
right? Of sometimes quite substantial
Correct.
leakage, right?
Yes. So we want to minimize the leakage, hopefully by having an attractive transaction, having an experienced team, and then having done a good job of articulating the growth opportunity.
Huh.
So now you have that, they go through and from an IR perspective, and I think for your listeners, the IROs out there, it's about all the traditional things you need to do. You're not going to inherit any sell side coverage. No analysts are going to be covering the company, so you need to get out there and work with ideally an advisor, ideally ICR, and help you go out and say, hey, look, who are the analysts that are covering it, and figure out ways to make it attractive for that analyst to cover the stock. You need to go out and find out who are those potential
That's
shareholders.
harder and harder. Paid research? No?
Paid research is. I think that there are some options that are out there. There's some more quality shops that are out there, and I think that the universe of sell side coverage is becoming more competitive. There's a shrinking environment, some regulatory changes that I think it makes it a little bit more difficult to get coverage, and I think that puts a premium on using the air cover of media. It would be great to get some good media coverage that kind of articulates what the investment thesis is and what the growth prospect is, in lieu of or until you can get some sell side coverage. So and then
that's a really important part of the whole process is the media outreach to Wall Street Journal, but just
even
main town.
Whether it's local media now, you have the ability then when if you get something that you get a story in a smaller publication, then you have now through social channels you have the ability to really push it out there and get it in front of investors. Leveraging local media, leveraging relevant trade media, leveraging the overall transaction media. So there are multiple ways to get the story out. And then if your SPAC sponsor has a strong media profile, he or she has the ability to leverage that profile to help tell the story and articulate the value that they see in this transaction and then why they're excited about it. So I think that the from an IRO perspective, it's about okay, what should our shareholder base look like? How do we go out and get in front of those shareholders? How do we craft a story that's interesting and compelling to them? And then that's the difference between a traditional IPO. You have that a little longer time. You have the ability to share forecasts. Right. You have the ability to share a little bit more information, and hopefully then build over time. The shareholder base is going to transition.
And part of that communication strategy, I think, might diverge a bit from sort of a standard IPO. Is one of the things you're pushing is the management competence. That's kind of the product, not only during the original listing, but also in the de-SPAC process. That is an opportunity, actually. Yeah. Because these guys sometimes are known on the street for their acumen and so on.
Correct.
So that might be a little different from an IPO.
Yeah, I think where it's
maybe they want to have their own sort of personal website or personal Twitter account, or
Yeah, no, I mean they tend the management teams that are the SPAC sponsors, they are going to play a role in the ongoing business, and it's going to be different. The ideal is, you're going to have the management team that's been running the business that they're merging with or acquiring in the SPAC process, and then you're going to have the SPAC sponsor management team as well. So depending on what their roles will be in the ultimate combined company, you may have the SPAC sponsor become a chairman of the board, play more of a board level role that is an experienced executive that could be a good advisor to a newly public CEO. So I think that's typically what you would see is they're going to come in. They may not always be operating the business. They won't be taking over operations.
Okay. No,
they may so that's ideally it's the operational management team is going to come in, and the SPAC sponsor team is going to be there and helping them grow the business.
So you'll be selling both management teams.
Correct.
Besides just the synergy of that and
Exactly
the
right.
operational advantages of the company.
And that's part of the value creation is that, hey, this is whether maybe it's a family business that is then looking to monetize, take some cash off the table. Now they are looking for the next generation of leadership for the business. Okay, great. They have a management team that they could put in place. Or it's someone that says, okay, yeah, same thing. We want to take some cash, some money off the table, but we want to still maintain our equity and we want to still run the business. But it would be great to have the access and experience and insight that this senior leadership team brings to help us do that.
Okay, so you're at the point now where you've merged essentially management teams. What's your communication strategy at that point?
We'll go back a little bit. So during that de-SPAC process, it is, as I like to say, it's like you got to be changing the tires while the car is still going around the track.
Yeah.
Because now you've announced this transaction and you've got a private company that hasn't been doing an IPO prep process necessarily. So now all of a sudden, there's a lot of work to be done to prepare them to be a successful public company, but also to be able to go out on the road. It's developing that narrative, the messaging. It's putting together an investor presentation. It's training the management team. It's getting out the process of putting out press releases and telling their story, establishing those protocols. It's then going out doing the roadshows, meeting with the investors, doing an analyst day or an investor day to
Not much different
articulate
than any
other
typical IPO.
Correct. And now you've got to do all the infrastructure of setting up an IR website and all the things you need in place in order to be a fully functioning public company when the transaction is closed. So we're during that de-SPAC process, in addition to getting out and telling the story, meeting the investors and articulating the overall strategic rationale of the transaction, we're also working behind the scenes on all the infrastructure that you need to put in place as a public company. So now you get to the point of, okay, we come to the shareholder vote. The shareholders vote in favor of the transaction. As I said, now there's going to be typically a name change, a ticker change, hopefully a bell ringing to celebrate that occasion. And now you're off to the races as a public company. And that comes with all the things that you need to be able to do, from closing the books in an early fashion, to be able to prepare for quarterly earnings. And you're going to be doing that first investor earnings call and preparing for it and getting out and making sure that you have the right guidance in place, you have the right metrics that you're disclosing, that you have a good sense of what investors are looking for, an ability to answer their questions, and then making sure that getting out there and ideally engaging with the sell side, looking to build those relationships that over time hopefully will lead to coverage, getting out and being at all the right conferences and all the things that come with this traditional public life as a publicly traded company.
I'm thinking of the future for SPAC issuance.
Yep.
I'm thinking the economy might go down the tubes. Mm-hmm. What's that going to do for SPAC issuance? Is that going to be good or neutral or?
I think that from a SPAC issuance in a down market, I think that there'll still always be, particularly now as it has evolved, that there will be experienced issuers. And then I think when you do have a market downturn, I think also we don't need a research survey to find it out that those transactions that are done during tougher economies, ultimately when the economy improves, those are a lot better investments and they yield great results.
Right.
So I think that God forbid we do find ourselves in a slowing economy, dealing with a downturn. That's going to improve valuations, and I think for those long-term disciplined investors that are going to look and say, okay, I think this is still a great way, still experienced team. You're going to have private equity sponsors are going to look for transactions that allow them either to roll over their equity or to take some money off the table, but also participate in it. So I think that it'll still maintain, and I think as this has become a more mature and the structures have gotten more attractive to the institutional investors as well as the private equity sponsors, et cetera, that I think there will be continued demand for SPACs. And there's been talk about, okay, do you see bigger and bigger SPACs or smaller? I think that they're when you do raise more and more money, like anything, it's harder to find good targets or anything along those lines. So I think that you'll see continued activity. From an IPO perspective and capital raising perspective, I think that you'll still continue to see the experienced issuers coming to market, that there'll be demand for those IPOs.
Yeah, but would there be, relatively speaking, more or less in a down market for SPAC? Is there anything about SPAC and the SPAC structure that would cause?
No, I think it might be interesting because the structure could actually become an attractive place to park cash with very little downside risk in an uncertain market.
Okay.
So I think that it becomes, where I said earlier, they have then that optionality and say, okay, well, I could put my cash here. I know that if I choose, I could just ask for my cash back if I don't like the transaction, or if the vehicle doesn't identify a target. So I think in that environment, it becomes a more attractive spot for somebody that's looking just for cash preservation.
Phil Benning, thanks for joining us on the ticker today.
Thanks for having me. I appreciate it.
And that's your Ticker Podcast. My thanks to ICR's Phil Denning. Until next time, stay safe, stay away, stay digital. Send me a voicemail, jeff.cossette@irmagazine.com. I'm Jeff Cossette.
Citadel Securities is a member of FINRA and SIPC. The content of this podcast does not necessarily reflect the views of Citadel Securities.